Divorce is often one of life's most challenging experiences, emotionally, legally, and financially. But it doesn't have to feel so overwhelming. Welcome to the Smarter Divorce podcast, where legal expertise meets financial insight, empowering you to make informed decisions every step of the way.
Hi, everybody. Welcome to the Smarter Divorce podcast. I'm Jane McAuliffe. I'm the president of Collaborative Divorce Strategies. And here I specialize in divorce financial planning, and I participate in mediations as the financial expert. And today with me is my co-host, Kerry Raffinelli, who's an attorney who specializes in family law and also partakes in the mediation with me on the legal side of things. And today we have a very special guest with us. His name is Jack Cacchiotti. He's with Witham, which is a tax and accounting firm. And Jack specializes in business valuation. And today the topic is going to be, what considerations do people need to make, whether you're the business owner or the spouse of a business owner, as it pertains to divorce? As we know, these can be classified as marital assets. And oftentimes it's one of the biggest piece of the marital asset pie, so to speak. And so today we're going to talk about actionable items that you need to be thinking about if this is part of your equation. And Jack's going to share all of his knowledge and expertise on what gets baked into that. So welcome, Jack. If you want to give us just a quick highlight of your title, your background, and what you do at Witham.
Sure. Thanks, Jane. Hi, Kerry. So my name is Jack Cacchiotti. I'm a partner in the national accounting firm of Witham Smith and Brown. We're about 2,600 people nationwide, and I am in the valuation forensic litigation group. We consist of about 70 professionals specializing in business valuation, litigation, forensics, background checks, anything to do with litigation. But I specialize in valuation of companies in the context of marital separation or shareholder issues or estate and gift planning. So anything to do with business valuation, I head that area up.
Fabulous. And we've had the opportunity to partner with Jack on certain cases when, again, this comes into play. And obviously there's so many questions that people have, whether you're the business owner or the spouse of a business owner is, gosh, how do we even go about valuing my business? Obviously there's a few different types of businesses, and some of them may be service related, right? And some of them might be brick and mortar, where they're manufacturing parts and they're turning out widgets. And I think those are two very different aspects to when you're valuing a business, right, Jack? And I guess we're looking for insight, like, are there two different strategies or approaches to valuing those different types of businesses?
Yeah, great question, Jane. It comes up all the time. So I always tell people that, certainly in the context of this podcast, we're talking about marital separation. So anytime there's a marital separation, as you both know, there's always the tangibles and the intangibles. The tangibles being real estate, cars, jewelry, those types of things. And then there's the intangible when it comes to the one of the spouses own a business. And that business, as you mentioned, may be a service business where there aren't a lot of tangible items, equipment and vehicles and those type of things. And so most of those service type businesses are considered intangible assets, different from a manufacturing plant or a retail outfit where there's stuff, there's inventory, a brick and mortar, there's real estate. So, our job is to specifically value the business and whether that business has more intangibles than tangibles or vice versa. And so we look at it, what type of business is it? Again, focusing on a service business where there isn't going to be a lot of stuff. And so how do we get to the value of that business? Different, again, from a manufacturing or retail type business where there's stuff and we bring in certain experts to value real estate or equipment or inventory and those type of things. So you first start with what type of business is it. Once you get to that point, we go about three different ways of valuing a company. If you'd like to elaborate on those approaches, I'd be happy to.
Yeah, why
Uh,
not? Let's do
yeah,
that.
sure. So I tell folks, and again, sometimes this is people's first time getting involved in valuation. They have had a company for 20 years, or the spouse who doesn't own the company has no idea on how do you go about valuing the company. So I try to break it down to what's the simplest way to explain to a client on how we're going to go about this. And I think over the years I've gotten to a point that the easiest way to explain to someone is to say it's no different than a real estate appraisal of a investment property. So for example, if someone owned a three-family home, okay, there's a business will look at it the same way. So there's three ways to value that three-family apartment. There's the asset approach, which means what would it cost to reconstruct that building? And we'd bring in a real estate appraiser to say, hey, it's three floors, you've got to buy the land and you got to build it, and there's labor, and come up with all these costs to reconstruct that property. No different than the business. If it's heavily tangible assets, like we talked about, what's it going to take to replace those assets? What's it going to cost? So that's the asset approach to valuation. The second approach is the market approach. Again, no different than a real estate appraisal. What are the comparisons? What is the next three-family apartment building? What is that bought or sold for in the last couple of years? And how does it compare to our three-family house? Is it better or worse? Does it have more land, less land? And so we do market comps. Again, dovetailing that into a business, we go out to the market and say, let's find some businesses that have been bought or sold that look like this type of business that we're valuing it. And I can tell you from experience, there's none that look exactly like the business, unless they are the type of businesses like franchises, where Dunkin' Donuts, one looks like the other, or Kentucky Fried Chicken, they all look alike. There's a lot of comps, so it's easy to find comparables on those types of businesses. And so we subscribe to a lot of databases that give us market comps of businesses that have been bought or sold. And we look at them from what type of business it is, the amount of revenue it's doing, number of employees. And sometimes we get lucky and get 50 or 100 comps. Sometimes we're unlucky and only get two. So we look at it from a market approach as well, just like if someone were doing a market comp on a piece of real estate. And then the third approach is the income approach. And again, on an investment real estate property, those types of buildings are valued based on what is their revenue they bring in and what is their net income after expenses. So you add up all your rental income, you subtract your expenses, and you get to a number, and then you put a multiple on top of that number. Same thing in a business. We look at the revenue minus expenses, come up with a bottom line number, and we put a multiple on that bottom line number. So once we do all those three approaches, hopefully if we get lucky, the three approaches sort of come within 10% of each other as far as value. And then we look at it, if it didn't, why didn't it, and so forth. And we sort of come to a general consensus of maybe it's better to look at this from a market approach, or maybe it was better to look at it from the income approach, or maybe an asset approach. So we try to reconcile those three approaches to come to a consensus of a final number. So that's sort of the 10,000 foot way we do it. And I try to explain again, a lot of folks understand, real estate comps. They understand that type of stuff. No different here in the business valuation world. So that's
Right.
how we go about it.
That's great. Obviously you talked earlier about the different ways that the valuations come into play. I get all kinds of questions from clients on the financial side, maybe from the out spouse, the person that's not heavily involved in the business, that is the spouse of the business owner. And some of their questions come with, how can I be assured that my spouse hasn't leveraged out his business or her business in the past 5 years? And then, I don't know what he makes. I know he pays himself $250,000 a year, but we're living this lavish lifestyle. And my concern is getting to the bottom line of what would be considered marital income as a whole from this business. Maybe you can speak to that. Do some of these things come into play or discoverable in a business valuation?
So that's a great question, Jan. We always start off with requesting 5 years of tax returns for the business for a lot of reasons, and some that reasons you just brought up. And first of all, if we were doing it for the IRS requires that we take a look at 5 years. And the reason why we require tax returns is because we believe, absent any tax fraud, that that's the best source of information, because the business owner is signing those tax returns under penalties of perjury, and you would hope that those returns are filed accurately and the revenues and expenses are accurate. There have been cases where we've seen tax returns that don't make any sense to us, and so we'll have to do a deeper dive. So we generally get 5 years. The second reason we get 5 years is we'd like to know the cycle of the business. Is it doing this? Is it going down? And generally on those business tax returns is a line item called officer compensation. So to answer your question earlier, on that line item would be what the officer or owner is taking out in compensation. And we look at that number and we compare it. Again, when I mentioned market comparables, we have databases on compensation to tell us that a business owner in this type of niche or industry should be earning X or Y. And we look at if his salary is too high or too low. And the reason why we specifically look at that area, to your point earlier, if a company is earning $5 million a year in revenue and it's putting no money to the bottom line, zero profit. And again, I mentioned earlier, we take that profit and put a multiple on it. But if it's a zero profit, 0 times 10 is 0. So several ways that business owners manipulate that bottom line is they just take it out in compensation. So they may be taking out $1 million in compensation, driving the business value down to 0. And so we would say, look, $1 million is too high. We think the salary should be $300,000 or $400,000, and therefore the difference drops to the bottom line. And then we can multiply that and get the value. That's one of the reasons why we look at 5 years. We like to see those numbers if they fluctuate or not. And a second issue like that is, and I'll dovetail into this, I think it's a good segue, is if the business owner owns the real estate that the business occupies. That's another way business owners get money out of their business. They just pay themselves a higher rent. And so, again, driving the bottom line tax return to 0, yet taking a high rent out and putting it in another entity. So we sometimes bring in a real estate appraiser to say, hey, what's a fair market value rent for this space? And he or she may say to us, well, it's $10,000 a month. And we find out that this company is taking out $30,000 a month. So we normalize that back down to what's fair, and therefore the bottom line starts to get more normal. And then again, as I mentioned earlier, we put a multiple on that bottom line and we get the value. But that brings up your other issue. So if an owner is taking it all out in comp, then that brings your expertise in, and Kerry's expertise is, okay, maybe he's driving the business value down, but he's taking out $1 million in compensation. We're going to go get after it in alimony.
Yeah.
Right. So,
yeah.
And we try to tell spouses, you both can't have it both ways. You can't have a high business value and then still go after $1 million in compensation for alimony. So we kind of have this give and take. And as you guys do mediation and so forth, I'm sure you get involved in that kind of thing. So, but again, that's why we look at 5 years to see what the trends are and what's happening there.
What I'd like to jump in to tell the audience about is working with Jack in the past is, and Jack and I had a case one day when it was a room full of accountants and lawyers. It's a day I'll never forget. And so, yes, you have to have accountants. They're a must. If it's done properly, one accounting firm working for both parties for this sole purpose is ethical because they're not advocating for one or the other. They're getting to the number. But that, as Jack can attest, that sometimes you can find yourself with 3 lawyers on this side of the table, 3 lawyers on that side of the table, and 2 teams of accountants, but it's still getting to what are the numbers and what methods are being utilized. So I find that what Jack does, and why we're relying on for this podcast, is that he can be, if you will, the mediator of the numbers, the middle. So working with mediators like ourselves, as well as Jack and his firm or his assignees, once again, it's getting to the middle, as we stress to people that mediation is. Getting to the middle, getting to a number that's fair to both, not favorable to one, not favorable to the other.
Yeah, correct. And, just like any other, like you said before, a real estate appraisal, right? A business valuation is sort of the same. I mean, you're relying on numbers, but that is also an opinion of value, right? Because there's so many things that you or I or Kerry, just looking at documents, can't decipher, because there may be other explanations behind that would require input from the business owner, right? And I know we talked about this before, Jack, or it was one of the topics that I wanted to cover today, is service-related companies. The business owner who is in charge there, most of the times they say, well, my business isn't worth anything because if I go, the business goes, right? So that's known as goodwill. And that always is a component of a business valuation from the service side of things. Is that right, Jack?
Yeah, so that's a great question, and it's a very hot topic, and it's a very complicated topic. And I think, again, it's very state specific. So in Rhode Island, where we do most of our work, personal goodwill in Rhode Island is not subject to marital division. So, for example, if we have a solo practitioner dental practice and the dentist has maybe a receptionist and maybe a hygienist, and that business needs to be valued for marital separation. Oftentimes we get that exact answer from the doctor or dentist to say, that's great, you think my business is worth $1 million, but if I don't come to work in the morning, nothing happens. Versus a 20-person dental office or 20-person doctor office that there's still 19 doctors practicing. So if one person doesn't show up, the business doesn't fold. So we find that the smaller the business is, meaning number of people, or if it's a sole professional that's running it, the more personal goodwill the business has. So for that same example, if we thought the practice had a value of $1 million, we may find that of that $1 million, $700,000 or $800,000 is directly related to the solo doctor, and therefore the business for marital separation value only has a value of $200,000. So we bifurcate that personal goodwill versus company goodwill. That's a 1-minute example, but very difficult to allocate. And again, the larger the practice or the professional service, whether it's a law firm or a doctor or engineering company, the larger and more professionals, the less and less personal goodwill exists in the business. So, while the business may have value, a lot of it may be personal goodwill, and that's a bad thing for the outspouse, but good for the in-spouse that has the practice. So that's a hot topic. In some states, I can tell you, don't differentiate where there is no personal goodwill aspect, and therefore if the dental practice is worth $1 million, there is no bifurcation, and therefore the whole $1 million could be subject to marital separation on the balance sheet. So
Wow.
So it's, again, as you know, state specific type things enter into play.
Yeah, and I think we've run into a case where the husband had the business and they had a business valuation done, and goodwill was applying, let's say, a 30% discount. Wife's business valuation expert had a disagreement with that. So in those situations, because really both parties are entitled to have their own business valuation performed in the case of a divorce or a separation. And I feel like that's such a good reason to come to a mediated setting to have, because both of the business valuations are opinions of value to
Right.
some degree. Okay. So in mediation, Kerry and I often work with both of the parties saying, okay, we've got a business valuation here. The numbers are this. The other spouse may say, we disagree. We're going to have our own. And then how do we bridge that gap to a settlement that feels fair for both of them? And that directly relates back to, what I'm doing with a couple in mediation is looking at the total marital estate. Are there other assets that we can allocate to the out spouse now that might take care of an ongoing payment? So it all relates back to a global settlement. And at the end of the day, both spouses do need to agree on what that number is. Obviously, we rely on experts to give them their professional opinion. And obviously your report, I know you've testified on trials, Jack, to, defend your position, but at the end of the day, it will come down to both parties agreeing to what they think is fair and equitable between them.
Yeah, good point, Jane. As long as I've been practicing, I've testified numerous times. And I find that, judges don't want to force the sale of a business to satisfy the marital division. So the judge will always say, you guys have to work this out. You have to mediate this. We're not going to sell this business. That's the bread and butter for the family or the respectively. So you're right. It is best to mediate those type of issues. And I find that, when there's two business valuation professionals involved, and if they're both doing their job and interviewing the parties and getting all the information and applying all the standards and the approaches we talked about, those professionals, just like real estate professionals, we should come within 10 or 15% of each other, give or take. It's when we come when we're 50 or 100% off, we have to question, why are we so far off? Is someone being biased? And those become difficult situations. So, but for the most part, two good professionals should be within negotiating amounts. It's, again, you said it was an opinion. It's an opinion. It's like art. What I think might be high, you don't particularly care for it. We probably disagree on the value of the art. We're dealing with numbers, so it should be a little bit more finite. But at times, I've been in a position where we're way off, and that's we have to find out why. Why are we? Why do we take a different position? That should, like, for example, we talked about earlier. We think the compensation should be 500,000, and the other appraiser said, no, I think it should be 700 or 200. Well, where did you get your information from? Let's look at the databases. So there's reasons why we would be different, but we should come within striking range.
Yeah,
you would hope.
That's great. And
because
I know
because if you don't, the judge will. So that's why.
Exactly. And when it goes to trial, it as you know, divorce trials are not, they're very emotionally driven. It's not,
right.
It's very difficult, but good point, Kerry. Yeah, the judge will, will, somebody's got to make a move. The judge will force it to move.
And everything's relative. Within significant business asset values, the parties could easily spend on accountant fees, testimony fees, and the attorney preparation fees as much as, if not more than, the delta that's in debate.
Exactly.
Yeah,
it's just like any other litigation. What is the cost of getting this to the goal line? Is it worth it? Let's try to settle to save all kinds of time and fees.
Sure.
Yeah. So Jack, we've heard this a time or two. Kerry, I'm sure, has in his long career of practicing family law, that a business owner might come to him and say, my business is just completely defunct right now. I am doing no business. My business revenue is down significantly. And lo and behold, it seems like there's something fishy going on where they know they're preparing for a divorce and maybe running their business a little differently right before they file, or right before or, leading up to the filing of a divorce. Is that something that you as a business valuation expert could substantiate or maybe get an explanation on, or kind of shed some light on that?
Yeah, that's an excellent point, Jane. We don't see it often, but we've seen some cases where, again, someone knows they're going to be splitting up. For the life of me, can't figure out why someone would tank their business for that reason. But maybe they are postponing revenue. I'll use that word, postpone.
Great way to put it.
So, for example, if a party is in a divorce and we're in the fall of the year and the business owner knows this is, he's got a valuation person in there looking at numbers, he may say to his couple of good customers, hey, why don't we push this off? You don't really need this service or this particular job or asset till the springtime. So why don't we postpone that project? I've seen those things happen. And so what we try to do, again, that's why we look at 5 years. We want to see if this business has been trending down for a couple of years. Why is that happening? Is this particular business owner anticipating a divorce? In particular example I gave you, postponing that, or maybe the counter to that is he or she is front loading expenses to say, hey, let me make 2024, 25 not look so well. I'll pay some of my vendors in advance to get some cash or profits postponed. And again, these 5 years show that. We'll ask questions. Why is your cost of sales 50% this year and last year it was 40%? The typical answer might be, well, cost of product has gone up. Well, tell us why it's going up. Is it one particular, so it doesn't happen often, but it does happen. Business owners have a way of doing that. Again, I don't know why someone would do that and jeopardize the business after the divorce is over. And now maybe you lost that contract by postponing it to try to get it out to the year. So we don't see it often, but I've seen some things that have happened. And again, the numbers don't lie. It's all
Yep.
about the numbers. We do a deep dive into the numbers for that. For that's another reason why it's looking at trends, what's happening here.
Yeah.
Uh,
Yep.
uh,
That's great.
the other side of that is, outright fraud or theft. Where you would see, and again, you mentioned earlier that the outspouse sometimes is in the dark.
Yeah.
But they're living a lavish lifestyle, yet the business doesn't warrant that.
Yep.
I'll give you a very quick example, and I think it's a great example. Many, many, many years ago, we had to value don't take offense, a law firm for a marital separation, and this particular lawyer was doing very well. Their lifestyle was great. And when we looked through the books and so forth, we didn't see a lot of profit. And this was a type of law firm or law practice that you could tell back in the day dealt with cash. It was criminal defense, those type of things, and those type of law practice tend to deal in cash at times. So the lifestyle wasn't justifying what was on the books and records. Lo and behold, we made a site visit of the law firm, and I had taken someone down with me who knew something about art. And when she walked in with me, she saw a couple of pieces of art on the wall in this attorney's office. And this art was, was done by some famous artists, in the hundreds of thousands of dollars, if not millions of dollars worth of art.
Wow.
And so I wouldn't know the difference between that and a picture I could buy at Home Goods. So I wouldn't know. But she said to me, Jack, I forgot the name at the time. And I said, well, what does that mean? She said, that painting's worth about $600,000-700,000. So this particular attorney was getting cash and burying it in art. wasn't putting the cash in the bank or wherever. And so you have to look at the type of business it is to say, is this business susceptible to fraud? So again, I brought up a Dunkin' Donuts earlier. I mean, they're all on credit cards, debit cards. They're a franchise, very, very difficult to hide money.
Yeah.
So you wouldn't expect it to happen in a business like that. And most businesses don't. But if you have to look at the type of the business to say, hey, is there a fraud risk here? Is there a theft risk, or is there a hiding of money here? So you got to look at the type of business. So that's the point. But I thought it was a great story. We had an art appraiser come in, value those pieces of art, and no one brought up fraud or theft. They just said, hey, we'll just add those art works to the marital balance sheet and let it be.
And you touched upon a couple things that just jogged my memory. Like, obviously part of this equation is you might schedule a site visit to visit the structure, the place of business, so you can see it and get a feel for it. And then also the cash component of it, a lot of questions around do we even go through with a business valuation because there's so much cash? Like, for instance, a landscaping company, right? They might get paid in cash a lot. I can think of that off the top of my head, but does that bear any weight? Is there like a cash, number that you could add to the bottom line, or is that just sort of left out altogether?
So those lead into, Jane, on forensic techniques.
Yeah.
Number one, we have forensic people that can find that out, but more importantly, IRS agents can figure that out too if they were getting audited. So, for example, you brought up a landscape business, and if this particular business had 10 people on the payroll, yet their revenues are just not that great. So it begs the question of, what are these 10 people doing? They're all making fairly good money. So that brings to light that there might be hidden revenues. And I think you both know that sometimes when we get involved in evaluation, we may find that, and we bring that to your attention or Kerry's attention and say, hey, look, we've got an issue here with unreported revenue. And I think you both know that when judges hear that, they have an obligation to inform IRS. They don't want to. So I think that forces the mediation, again, bringing it back to you guys to say, hey, look, or you make that allegation to the business owner. Hey, we think, our experts came in, they think there's some unreported income. Do you want to go down that path? Or do you want to sit down and try to mediate this and get this done so it doesn't have to go down that path? I don't see it often, but very few people will dig in and say, hey, do a forensic audit, but that gets expensive. But it's a good point. But there's ways of testing, on very obviously there's something not right here.
Yeah. I mean, I do tracing on a much smaller level. Like, I call it tracing. I don't really call it forensic, but and I'm not auditing people's books, but what I can do is look at bank accounts and see, deposits, random deposits. Can you explain these deposits? Like, if it's going into the business account and they're not, can we get a record of if it was paid by check? Can we reconcile it with the books? And that's where the CPA might come in to help reconcile that. But it's a good question. And then sometimes, the spouse who's questioning it says, we always had a cash in our house, and there was always, $50,000 in cash in there. And so I know the business is doing a lot of cash revenue. So again, forcing those conversations to happen. Definitely mediation is a place to kind of work that through and try to come to a resolution on that.
Yeah. Again, judges don't want to get into that in the courtroom. Even though they have an obligation to report, I don't believe they want to do that. So when they start to hear that by experts or on the stand, they'll take a recess and let's take this to the other room and try to mediate this out.
Plus the two of you could speak to this about lifestyle analysis, I suppose. At the end of the day, what you're doing is going to bear itself out, so that family court surrounds itself in full and open disclosure. you're doing things under oath. People should learn to do this above board. We know it doesn't happen with all, but how did you get that if you only earned this, is what you referred to earlier, Jack. I mean, at some point in time, it's all got to make sense. There should be a full and open disclosure. Mediation is the best way of getting that as well. It doesn't always have to be from a negative. It can be from a positive. We both know how we've lived our lives. We both know what the average earnings were. We both know what our children need. I like to go the high road, the positivity, the fairness route. And I think ultimately, as you said, with leverage of under oath, swearing into something under oath on an affidavit or in front of a judge, it's important for people to realize through this discussion that open and honest disclosure is probably the best order of the day anyway in settling your case. Mm-hmm. You can't send kids to 120,000 net annual income tuitions a year if you're only making $52,000. Right?
Yes. So then once the business valuation is done, then obviously the next thing to determine is how is the outspouse getting paid for their particular share of the business, and what percentage of the share of the business are they going to get paid? And Jack, you probably don't get into that piece too much, but that's where Kerry and I get into, the division of the marital estate and how to structure the payout or the equalization, as we call it in family court, of those assets from the business owner to the outspouse. And it's not as if every business owner can just turn around and write a check for $500,000 or $1 million. So then it becomes a discussion about a creative settlement scenario where we're trying to allocate existing resources as part of the buyout, maybe a payment over time. And then if the payment over time is coming, at what rate, because technically it's a loan to the outspouse. So there's a lot of different factors that come into the actual division of that business once the valuation's done and they've agreed to a value. The next steps are figuring out how to divide that, and also and how that's all going to happen.
Right. Just like a business deal, we've gotten to the number. Mm-hmm. How are we going to effectuate that happening?
Sure.
Are we going to leverage it? Is it going to be a note over time to the outspouse? Can the business afford to pay the outspouse for so many years? So you get into the deal structure. But what I wanted to bring up, because I thought you were leading into this, but let's say we have a business owner that is not 100%. He or she doesn't own 100% of the business.
Yeah.
He or she may own 50% of the business or 40%. Mm-hmm. Again, state specific. So if we have the same business, it's worth $1 million, and we have our in-spouse owns 40%. You would think the math would be very simple. Take $1 million, multiply it times 40, and there's the number. As you both know, in Rhode Island, if a business owner owns 50% or less, Rhode Island would consider discounts, minority discounts, and marketability discounts. So that same 40% business owner, while we would think it'd be 400,000, may be worth 250 because it's not a majority control of the business. He or she doesn't have control over the things we talked about, compensation and rent and all these types of things. So Rhode Island allows discounts on minority interests where other states do not. So again, state specific on minority less than majority owned businesses. And those are another hot topic of areas to mediate. Those are very, very difficult discounts to place on those businesses. Again, we have statistics, we have data and those types of things, but valuation experts will always disagree on what those discounts would be. And those are areas for mediation as well. So I think when business owners own a minority interest, I think it's more beneficial to be in mediation to keep the experts out of not only trying to value the business and coming up with a number that might be palatable, but now I've got to apply some discounts to it because it's a minority owned business. And so there's a lot of room for not only error or opinions, but there's a lot more room to mediate that. So you don't have to get into all that. So again, state specific. There are other states, it's not an issue.
Yeah.
So I think you have to be cognizant of those things as a business owner or an out spouse of a business owner. And that's a difficult explanation to an out spouse is, okay, well, why isn't it 40% of $1 million? Why is it 25% when he or she owns 40%? Well, who's going to buy 40% of a business and pay full price when they don't have control or could be fired or could, those types of things. So that's a hard thing to explain and certainly not only explain, but for someone to digest is why do I have to get a discount on that?
Yeah. And we've also seen, at times, if we're dealing with a minority business owner, sometimes it can be difficult to have someone looking through the books and records to that degree because the majority shareholder might, I don't know how you get around that, but certainly the majority business owner might not want someone all up in their books and business to buy out their minority partner, right? So how, what do you? Is that a roadblock at times?
It is a roadblock, and sometimes it's an intentional roadblock to say, if I'm a 40% owner and I have a partner who's 60, and I say to my partner, I'm going through a marital issue, and if you can put up some roadblocks, that would be great.
Yeah.
So we've been involved in a few situations where, look, I need 5 years tax returns, I need records, and they would come to us and say, the majority owner won't release it. I don't have access to it. I can't get to it. So now we have to go into subpoenas and those types of things, and it just drags it on. And you know how litigation goes; it goes on forever. So, yeah, a minority issue can be a roadblock. So those aren't fun. They just drag it on.
Yeah, eventually it will happen, right? To some degree,
we'll get there.
They will have to produce what's been asked either by will or subpoena. Exactly. And again, it'll just cost that much more if it's in a litigation scenario.
Exactly.
So speaking of costs, I know we're running short on time. If you want to give us like the general costs to do a business valuation, I know a lot of people are, wondering like, can I do a full-blown business valuation? Can I do like a light version of that? And just a generalization of maybe the costs of what people might be looking at.
Yeah, so I always start off, Jane and Kerry, when someone comes to us and say, look, I'm in a marital litigation case and we need to get the business valued. And I always ask, is it litigious at this point? Are we in a courtroom? And well, we're not. And we don't plan on it. And that's always the answer. We're not, but we know that it could go farther than that. So I tell people, look, let's start off with some schedules. Let's get our arms around the 5 years. Let's see what it might be. And let's just do a lot of schedules and get our arms around a number. Mm-hmm. And sometimes maybe that's enough for both parties to move along or mediate or get the deal done. If it is, when I get a call and it's already, by one of you or Kerry or someone, it's already beyond that. We're entering into litigation. There may be a trial, so forth. The courts require a full opinion of value, which, I equate again, going back to real estate. Do you want the drive-by appraisal, or do you want someone to walk into the house and look at it and get into all of the bells and whistles? So the drive-by is much less expensive. The full opinion is very expensive. I can give you ranges, and I'll give you the ranges just for the audience. We do a lot of SBA valuation work where a business is being purchased, an existing business is being purchased, and the SBA is going to provide the financing, and we can do a real good scaled-down version for SBA and banks that are very acceptable, full, nice narratives and so forth. And those are around $3,500, but they're very small businesses. They're pizza shops, gas stations, those types of businesses. When they're full-blown $10 million, $20 million, full operating businesses, then they become more expensive. And they can run from $10,000 to $12,000 to $15,000. And, obviously there's all kinds of spectrums.
Sure.
But a business valuation range from scaled down version, like $3,500. The full blown report could be 15, somewhere in between.
Yep.
And again, in your case, sometimes both parties want to hire us jointly, so they both don't have to spend $10,000 each. The downside of that is somebody's not going to be very happy, and they certainly have the right to go get their own. So that's an option to save some costs. But again, that becomes difficult to satisfy both parties. Not, again, we're just part of the litigation and mediation cost. I mean, we're just one part of it. You have your the things that you handle, not valuation, but 401ks, stock options, and other assets and cars and all this other stuff that a marital estate has. This valuation, sometimes it's the biggest part of it, sometimes it isn't, but it is, from a cost standpoint, it's part of, again, like business, part of doing business, part of the deal.
Yeah, exactly. Well, Jack, I don't know if you have anything to add, or Kerry, if you have anything to add.
No, that was a great job, Jack. Thank you.
No, thanks for having me. I appreciate it.
Thank you, Jack.
Great stuff. Great stuff. Thanks.
Where can clients and viewers find you?
So if you go to witham.com, withum.com, you go over to our forensic valuation link, and all our valuation, litigation, forensic, fraud services are listed there, and all the partners who handle those types of things, we're all right there. All our bios, all our credentials, our designations, where we practice, which states. So take a look at it, and that'll give you a full-blown education. There's a lot of good articles on there as well that may relate to what we just talked about. But good stuff there.
Thank you.
Thank you, Jane. Thanks, Kerry.
Thank you, Jack. Thank you very much.
For folks viewing, if you are interested in mediation or divorce financial planning, you can visit Kerry and I at www.collaborativedivorcestrategies.com, and you'll learn more about what each of our roles are, and you'll also find a whole bank of our podcasts there shortly. This is episode number 5 on the topic of businesses and business valuations. So thank you all for joining us. Have a good day.